Good evening, Piyush. Welcome to have you on board. Wonderful to see you here. And I thought we could start by you just painting a little bit about the whole macroeconomic picture and from your vantage point, where you see the current economy and the trends today.
All right, thank you, Puneet. First of all, it's a pleasure to be able to talk to such a distinguished audience. My association with TiE goes back some way, and particularly when you were here in Singapore, Puneet, we did a lot of stuff with TiE as well. So
Yes,
it is a real privilege. All right, I thought what I would do is spend a few minutes giving you my take on 5 or 6 big macroeconomic themes and how I'm thinking about them, and then maybe potentially a little bit about the banking sector. On the macroeconomics, so I think number one, I don't need to belabor the point, but this is without doubt the most severe economic recession that we've seen in a long period of time. India, of course, at 23-24% for the second quarter was extreme. But if you look at the rest of the world, Europe's at 14-15%, Singapore's 13%, the US is 9-10%. So everybody's down quite significantly. I think the overall expectation is global GDP is going to be down somewhere between 5.5% and 6% for the year. Now you try and think about what that means. An $80 trillion world. So 5-6% drop on that is $4 to $5 trillion of complete destruction of demand, complete destruction of economic activity. And so the first takeaway is really this, that even if you see a bounce back, and no matter what part of the alphabet soup you choose, whether it's V or W or U or L or K, the truth is that we will be lucky to regain 2019 levels of economic activity before late 2022 and perhaps 2023. That 2 or 3 year loss of complete economic activity is very material. The second takeaway with that is quite simply that this is not an even problem. It's a very uneven problem, and the unevenness of the problem is quite clear. First, it's very uneven by country, and partly is determined by healthcare. The people who manage to get their hands around the pandemic more quickly, a lot of the North Asian countries, for example, will do better than others. But it's principally driven by the capacity of countries to be able to throw money at the problem. The richer countries or countries like the US, who have the exorbitant privilege of having the reserve currency, can throw a lot more money at the problem to cushion this downfall. Countries which have more challenging situations and fiscal or current account deficits or high debt to GDPs or inadequate capacity to borrow can throw much smaller amounts and quantums of money at the problem. Again, India is the case in point there. And if that is the case, you find that the cushion or the ability to cushion the economy and people is going to be more limited, in which case it is likely that the recovery period takes longer. So it's not even by country. It is equally, perhaps even more so, not even by sector. There's some sectors where you will see demand come back more quickly. In fact, there's some sectors, if you're in groceries or supermarket or even anybody supplying goods into the digital supply chain or work from home products, you did okay. But there's some sectors, particularly cross-border sectors, so tourism, travel, hospitality, F&B, these sectors are going to take a long time to recover. So that's the second big challenge. I think a third part of the problem really depends on the nature and strength of the financial system in different countries. Without a doubt, the real financial sector problems are yet to come. Most countries have been able to cushion SMEs, they've been able to cushion individuals and consumers. Many of these cushioning programs run out in the latter part of this year. In some countries, they're extended into next year. But at some stage, the governments will have to stop trying to support SMEs and consumers. When that happens, you should expect to see a wave of defaults. In fact, I think there will be a tsunami of defaults in the SME sector. There will also be a wave of defaults and credit problems with individuals and consumers. God forbid, hopefully it doesn't precipitate into a property market crisis. Maybe we can talk about that later. But as a consequence of what I think is the next shoe to drop, the financial sector shoe, the capacity of different countries to be able to weather that is actually quite different. Again, some countries, India again being a case in point, the banking sector and the financial system was already challenged pre-crisis. And so if you layer on that another set of NPLs and credit problems and losses, that's going to create several times more headaches than countries where the financial sector and the financial system was more robust and solid going into the crisis. So I guess the first point to me is this, that there is a macroeconomic challenge. It is large, but the thing to take away is that it is uneven. And because it is uneven, the nature of the recovery is going to be stilted. And therefore, as you think about playing your game in the future, you're going to have to take into account this very stilted and uneven nature of the recovery. The second point on macro, I think the biggest challenge we have to be worried about is actually the challenge to jobs. Now, again, without a doubt, the job loss in the last 6 months has been extreme. And you see that in the data and statistics from around the world. It's true in the US where you had millions, 25, 30 million job loss. It's true in India with 80 million migrant labor and significant job loss on the back of that. In some countries, like I said earlier, the job loss is not visible right now because governments have given money to SMEs to keep afloat. But these are, and many of them, not all, many of them are effectively zombie companies, which means the job losses have just been kicked down the road. But my worry is not so much the cyclical job loss. It is a challenge. My worry is really joblessness or structural job loss. Now, why do I say that? I think the truth is that post 2008, 2009, while jobs came back and employment came back, the structure of jobs, the structure of employment has been very, very markedly different from the pre-09 period. The bulk of the jobs that have come back are freelance jobs, gig economy jobs, quasi-entrepreneurial jobs. The fact is that the nature of the large corporation, the nature of what caused the industrial revolution, lots of companies employing lots of people to do organized work, that has fundamentally been changing over the whole decade. If you track the most wealthy companies in the world in terms of market cap, and you look at the employment base, whether it's Google or Facebook or any of the big tech companies, they don't employ people. Amazon does for different reasons. But this, to my mind, is going to be massively, massively increased, this problem, in the next 5 years to come. What the COVID has done is explain and talk to people that you can restructure operations in fundamental ways, and through digitization, and perhaps even more important, through data and AI, you are going to wind up being able to do tons more jobs digitally and through technology than you could do before, which means the actual structural employment that you're going to generate in the next 5 years is going to be a big, big challenge. So the structural nature of unemployment to me is the second big thing to be wary of and keep your mind on. A third thing, which is a little bit of an outlier, and frankly, I don't know how to think about that, but let me flag it. In effect, governments and central banks have spent more money in the last 6 months than was spent in the entire 08-09 crisis, or frankly, as you go back any time in history, has ever been spent. And this is both fiscal, so the amount of money governments are raising and borrowing to be able to support individuals, put money in the pockets of consumers, put money in the pockets of companies, bailing out companies, etc. But it's also monetary. The amount of monetary policy easing done by the central banks, both these are at a record. So depending on how you count the beans, there's over 10 or 12 trillion dollars that has been put to work in the last 6 months. The world has never seen largesse of this nature and this size anytime. The entire QE1 plus QE2 plus QE3 was about $4 trillion. Now you're talking about $12 trillion. The impact of this from a macroeconomic prism is uncertain. So depending on which economic school you follow, you will either believe that the world is going to go into so much structural demand destruction that all of this money doesn't matter. What it will do is create a Japanification, which means that you will pay for this slowly over a period of time with maybe 0.5% or a 1% deterioration in your growth rates. I call that Japanification because effectively Japan, with its 300% debt to GDP, saw some degree of give up on GDP over an extended period of time. But the other school would say that effectively this amount of money, especially since a lot of that has been monetized on the balance sheets of the central banks, modern monetary theory, means that inflation has to come. It might not come in the next year or two with the demand destruction, but if you look 2, 3, 4 years out, inflation has to come, yield curves will steepen, and people will pay for it through hyperinflation over time. And again, the logic for that is simple. The quantum of goods and services in the world is finite. if you put 3 times the amount of money to buy the same quantum of goods and services, you have to see inflation somewhere. And frankly, as I said, it's not entirely clear to me where we go. I don't see inflation anytime in the short, medium term, but logic tells me at some stage it might show up. The outcomes of that are unclear, but it is something worth flagging. The fourth thing which I want to flag is a challenge which has been on us for some time again, but again exacerbated by the COVID, and that is a challenge of geopolitics. Quite clearly in the last few years, especially since the Trump administration, but in some ways before that, the world has been moving away from the multilateral order that we created, the Bretton Woods arrangements of the Second World War, post-Second World War, and you're getting increasingly into what some people call a G0 world. Now, G0 world means effectively, I mean, you might get a bipolar world, a China-centric versus US-centric, but again, a lot of people believe that what you will wind up with is a lot of regional powers and a lot of regional blocs, but fundamentally an end to the multilateral regime. Now, this has got serious consequences. For certainly where I sit in Singapore, most of East Asia, we have benefited enormously from a very stable work environment. We haven't had a war in this region since 1975. This stable work environment, this rule of law, this nations coming together, this might not be the way going forward. More specifically, the issues and challenges between the US and China are going to be quite profound. I don't think you'll see a complete unbundling. The Cold War, which is 2 complete worlds of Russia and US, is hard because the economies in the world are too integrated. But I do think what you are seeing is a world where technology and the internet do unbundle. The splinternet, people call it. And so if you have to see a world where you can either deal with Huawei or you can deal with Cisco, you can either deal with WeChat and TikTok or you can deal with the American tech giants, that world has got serious challenges. If in the best case, it creates inefficiency. In the worst case, you actually wind up in a regime where if you deal with one, you're going to be sanctioned by the other. Now, this is going to create a particularly complex set of challenges. The fifth thing that I wanted to touch on briefly is the concept of sociopolitics. Now, this goes back to the structural unemployment question, but it is a little bit beyond that. Again, in the last few years, the last decade maybe, the nature of the capitalist model, the liberal capitalist Western model, is increasingly been coming into question because of vast degrees of inequality around the world. I think, again, the COVID exacerbates this problem. It brings it to the fore. The biggest people who suffer are the poor, the people who are at the coal face, the bus drivers and the shop keepers and the people at the cashiers, this thing. All of the white collar people are actually being able to protect themselves much better in this environment. But this is bringing social tensions to the fore. I think in the next 5-10 years, this issue of social tension, this class disparity, will be one of the most important guiding issues for most countries. I think you're going into a 1970s kind of scenario where there will be strong desire to look at redistributive policies. You will look at regimes of higher tax. You will look at agendas for wealth redistribution. And we know that when you go into some of these, you have populist and nationalistic drive. You don't always get the best outcomes. In fact, the 1970s were a failed experiment. Nevertheless, given where the world is today, I don't see any alternative but for political leaders and leadership to accept the fact that you're going to have to redress some of the issues of social grievance and social injustice. So I think there's going to be another big macro trend and challenge coming down our way. I will set 5. I'll maybe mention one briefly, and that is, I think, the sustainability agenda. You know, I say that because sustainability is, most people think of it as ESG, the environment, social governance. I just talked about the S. There's been less attention on S in recent years. I think that will dial up. But I also think attention to the E, the environmental component of the sustainability agenda, will also dial up. Some people think that because of the urgency and immediacy of economic recovery and jobs, people will take the foot off the environmental pedal. I somehow think about it differently. I think, people are beginning to recognize that tail risks happen. The pandemic was a tail risk. And therefore, the appetite to start dealing and worrying yourself about other tail risks, whether it's climate or biodiversity, I think a lot of people have figured we better start paying that some attention. Also, some of the money, the recovery that people are trying to construct, will attract money and investment to build back better, as the Americans call it. So the Joe Biden campaign has got $2, $3, $4 trillion decked against it. The European Green Recovery Fund has 750 billion euro decked against it. So I do think there's going to be another impetus on the green side as well. So Puneet, if I can spill over to a few comments on the banking system, and then we can go into Q&A. I think from a banking sector standpoint, there are 3 or 4 big things that are imminent. One, it's quite clear that given everything I've said, you're going to see a macro environment where interest rates stay lower for longer. In fact, probably zero interest rates, and probably for a significant amount of time. I think Governor Powell, the Fed Reserve Chairman, just suggested that this could carry on for 3-4 years. Now, of course, zero interest rates, low interest rates, in some cases, Europe and Japan, negative interest rates, these are seriously challenging for the banking industry. It completely destroys the profit model of banks, and this is going to be a headwind that all banks are going to have to deal with in the foreseeable future. The second big challenge to banks is what I talked about as the other shoe, which is yet to drop, is going to be the challenge on cost of credit, non-performing loans. So we already talked about that, about SME default, unsecured consumer default. The one element which I touched on, which I might want to amplify, is the property markets. My big worry is that if you do wind up with a wave of foreclosures, because most lending is collateralized by property, foreclosures in the personal mortgage space and foreclosures in the SME space, on the back of that, you wind up having to offload a lot of property. That can create a downward spiral in property. Similarly, if this working from home creates a new way of working, so commercial real estate comes under pressure from less demand, that could create some more severe challenges in property. And then retail, especially with people going to e-commerce and online, with the mall and mall space already being pressured, that could come under some challenges. So if you compound and add to the rest of the problems of the banking world, a possibility of a property market collapse in one or many markets, that could create a second set of big problems. A third set of issues for banks is obviously the digitization of the world. Now, this has been a challenge for banks over the last decade, with the competitive landscape changing. Today's competitors are Google with Google Pay, and Alibaba with Ant, and Facebook and WhatsApp. Everybody's getting into the banking space. So the environment is already changing. And some banks have been more adept at trying to embrace digital change, and some have been less so. Unfortunately, to me, the COVID is going to accelerate that distinction a lot more than we've seen in the last few years. The companies and banks which are not able to grapple with this, which by the way includes data and artificial intelligence and machine learning, are really going to start falling by the wayside. And on the flip, the Amazons and Googles of the world, I think they're going to double down and make even larger and more significant investments into the space, including many of the newer startups and AI companies. So at the same time, because consumers have got more used to digital consumption and a lot more in the last 6 months, you'll find that the shift to digital consumption, digital tools, digital solutions, that will continue to accelerate even more than we have seen. So there's going to be a third issue. A fourth issue, which is, I think, not just for banks, it is for the corporate sector in general, but I think the banks should be at the coalface of it, is going back to this idea of purpose. I think coming out of this crisis, there's going to be a lot of pushback from society, as I mentioned. It's going to be anti-rich, but it's also going to be anti-corporate greed. And you're seeing that reflected in this already shifting scenario from shareholder capitalism to stakeholder capitalism. A lot of people are now espousing the notion for companies to think about purpose, to think about intent, to think about how they're really making real impact. And banks are going to be very much part of that. Now, banks are going to come under heavy scrutiny in the next year because of the problem I alluded to, the bad debt problem and the default problem. There will be an expectation from society for banks to forgive loans, for banks to lower rates, for banks to give freebies. And the banking sector, given it's already on the back foot, as well as the regulators to ensure financial stability and to ensure getting around the moral hazard issue, will not be able to do this forever. So the programs are going to wind up, the government-supported programs. And as they start winding down, you're going to see a lot more challenges for banks about how do you determine who to continue saving and who to let go. So I think that's going to be a big problem as well. And finally, you talked about sustainability. I do think that banks are going to also come under a lot of scrutiny on the environmental issues, climate related, biodiversity related. So impact measurement, being able to make sure that you transition your portfolios to doing the right things, making sure that you don't wind up with stranded assets in those sectors and those parts of the economy which are not going to be able to make it. I think these are going to be challenges that the banking sector is going to have to deal with in coming years. So why don't I stop there, Puneet? I'm quite happy to dive into any of these at greater depth, or frankly, anything else you might want to talk about.
Thank you. Thank you so much, Piyush. This has been wonderful. You've painted a beautiful landscape in terms of what's happening today, and it's not easy to be able to navigate this ever constantly changing world. And some of these things that you touched upon, are obviously in minds of a lot of people over here. And so how do corporations deal with those newer jobs? How do they get their workforce transitioned there? And I know that DBS has done a fantastic job in terms of, shifting in that direction, but maybe you can borrow, a page from your book and figure out what you've done and, how everybody else can navigate that world, because it's a tough world out there and it's unevenly spread. So what do you think about that?
That's why I said then, I think this is going to be one of the most important questions that we have to deal with. Now, I'm going to talk about 3-4 different things. So let me see if I can pull it together. Let me first, since I'm talking to the Thai audience, let me start with that. I'm of the view that jobs as we know them, like I said, large companies, large corporations, etc., are unlikely to come back at scale. If you think about jobs in these large corporations, this was not the way the world was 200 years ago. It was all guild labor and small-scale enterprise. The Industrial Revolution spawned the big corporation. Henry Ford created the assembly line. It was about the same time that Max Weber described the bureaucracy or the hierarchical system of an organization. So the Industrial Revolution and the assembly line spawned jobs as we know them. And this because you needed large companies and large employment to create scale. Today, you can create scale without large companies and large employment. You can create something in a garage and you can get global scale by plugging into the technology and internet system. So fundamentally, the notion of jobs in the future, I do think you'll see a lot more smaller companies, which therefore makes the case, therefore, for a lot more entrepreneurship. And like I said, therefore, since the Thai audience is the thing, I think the world is going to need, and you're going to see a lot more entrepreneurship, a lot more smaller companies, and a lot more nimble companies. And that's what governments and policy architecture needs to try and create. How do you equip people to be able to handle a world where you're just not going to go and work for the Indian Railways or go and work for General Electric in the future? So that's point number one. Point number two, however, to the extent that there are jobs within companies and so on, I do think you're going to see that there is a shift in the nature of jobs. At DBS in 2016, out of our 20,000 people, I identified then about 1,500 jobs that would disappear in the next 4 years. That included cash tellers because cash is coming down. It included contact center operators because people are coming in more and more digitally, etc. We put in place an extensive reskilling program for these identified 1,500 people to see how we could migrate them into other jobs. We were able to reskill about 1,000, 1,100. We were able to migrate 700-800 into new jobs. Some people retired, some people quit. But as I look forward, this is going to double. In fact, I think about the next 3 years, I can see another 3,000 jobs which are going to disappear. And they're going to disappear because of technology and basically AI and data. Now, as these jobs disappear, I'm actively working at reskilling. I think reskilling works. I think you can teach adults to do things differently. But there's a finite limit on how many jobs you will find, even after all that. However, I think to your question, you have to make the effort to reskill. A lot of people are skeptical about whether adults can really learn new skills. Now, I'm of the school which says that there is no reason why you can't. And this is why we really focused on this whole agenda in DBS. We called it a 20,000 people startup. It was based on a simple premise. All of us, in your 50s and 60s, frankly, I got this insight from my father 6 years ago. He was 83 at that time. he changed the way he lives in his personal life. He was ordering things online. He was doing his banking online. He was doing his tax payments online. He ordered my mother a nightie online on Flipkart or something. And I'm thinking, if an 80-year-old person can change the way he lives because somebody showed him how to use apps, somebody showed him how to engage digitally, then why do we think a workforce in their 40s and 50s can't change? Obviously, the human brain can make it. It's only the organizational environment which doesn't let them make it. So we boiled it down to two things. One, people at us learn by doing. So at home, somebody comes and tells you, this is your app, your granddaughter will come and show you what to do, and you do it a few times and you figure it out. In a company, nobody shows you. So how do you create an environment where you teach people by doing and getting your hands dirty? The second big difference is the risk environment. At home, there is no risk. But in a company, the risk is high. Your bonus will go, your job will go, somebody will fire you, scold you. So how do you create an environment which makes it okay to experiment and take some risk? It's okay to learn from failure. If you can do both those things, then I think you can actually work very productively with people to change technology. Let me give a specific example. We had this big debate. We had a large technology team. We had a big debate on whether we needed to hire new techies to do Python and the new forms of coding we needed, or whether we could reskill the old techies who knew COBOL and C++. Our vision was quite simple. If you already know COBOL and C++, you know the banking domain. Those languages are tough. Python's an easy language. Why do we think we can't teach you and reskill you to do the new stuff? So we took this challenge on. We gave all our people some money to self-train. We set up academies and schools. We trained everybody in data. I've got a program running with AWS right now to teach everybody to do artificial intelligence and machine learning through creating your own car and racing the car. I did that as well. Our experience has been that you can reskill people. So I do think you need to make the effort. You need to reskill people. But my caveat to that is I still think after all the reskilling, the number of jobs that you get at the end of the day might still be finite. My third comment on the whole jobs question is, again, out from a little bit from left field. A lot of people think that the only jobs of the future are the new jobs. You've got to be a data scientist, a data engineer, a coding expert, do Python, etc. I think all of those are important, and we're hiring a lot more of those in the company. Today, we have 8,000 engineers in DBS, more than we have bankers. But at the same time, I want to make a pitch for the fact that I think some of the bigger problems that we're going to have to solve in coming days are really problems of the soft sciences and of the humanities. When you start thinking about the idea of data and data use, what data is it okay to use? What does data privacy mean? How do you think about data in a sophisticated way? The issues are issues of philosophy. They're not issues of technology. Right? What makes us human beings? What makes us different from a machine? What should we use a machine to do and what should we not? You need to think about philosophy, anthropology, ethnography, etc. So you need a lot of soft sciences as well. So I do think the skill sets can be broad. You can skill people differently. But at the end of the day, I think the jobs will be fewer. So you have to look at entrepreneurship and entrepreneurial small startups as a way out if you really want to handle the job question at scale.
Yeah, indeed, indeed. And actually, that's a good segue. Piyush, I'm not sure too many. I'll come back to some of the questions that I have about banking, but I want to just take a little detour here since you talked about entrepreneurship. Not too many people might know that you actually yourself had an entrepreneurial gig in 2000. You started a company called GoForI.com. And just would you like to share with us that journey? How was that journey? What did you learn over there? How was that experience?
So this was the 2000 era. So I said, like many other people, I didn't create a .com, I created a .bomb. I was in the city, I was doing well, but I had the opportunity to sort of get some sweat equity in setting up this company. The idea was to create a Yahoo lookalike, like Rediff.com now, but we were creating 5 verticals within that. One was in the stockbroking space. We actually had some equity interest in HDFC brokerage. One was in the job. I was a partner with Hindustan Times. So Hindustan Times had 40% of the company. So a second vertical was logical. It was in the job search space, like Naukri.com. So it was about 6-8 months after Naukri. A third vertical was in the matrimonial space. Hindustan Times is the largest classified matrimonial base. So that was more like Shadi.com. So that was the third vertical, and so on. There are a couple of other verticals. Now, as things happened, my timing was terrible. We started the company on the 1st of March in 2000. NASDAQ tanked in the second week of April. My funders, I had some venture funding, decided to pull the plug on all B2C funding. I hadn't signed up my contracts well enough to make sure the funding would be around. The funding disappeared. I spent a few months talking to the Lycos's and Yahoos of the days to try and get some strategic money. HT was willing to put content but not put money. So, end of story. I had a choice then, whether to stick on with some of these things. I could have reduced the burn rate and hung on for a long period of time. Now, this is sometimes the downside of having an easy alternative. When I left Citi, they told me that I could come back whenever I wanted. They'd find me a great job to do. And when the dot-com didn't work, to me, that was the easy alternative. I knew banking well. I was a good banker. They were willing to give me a big job. So I went back. If I had not had that option and stayed on, I look back and figure that all the places we're placing our bet, whether it was a Naukri lookalike or a Shadi.com lookalike or a stockbroking lookalike, over a 10-year period, there's a good likelihood that at least one or more of them would have been successful. The problem is it would have taken 10 years. And, so that's the trade-off that you need to make. I think my big reflection on entrepreneurship is this. If you really want to be successful, you need to go all in. You need to make sure you don't have a safety net. You need to make sure there's no easy way out. And then you have to be prepared to do the hard yards, because you could get lucky, but you have to be prepared to do the hard yards. But the people who do that can be extraordinarily successful. Now, what for me personally, what it did though, it changed my way of thinking. So, before then I was on the corporate ladder. You could call it a rat race. I was doing well, but I was really driven by the capacity to continue building my career and so on. Once you've done that, I'd taken my wife, my kids, I'd given up on our career, the whole thing failed. Your risk appetite increases. You lose your inhibitions once you've seen a failure of that sort. So when I got back into corporate life, I approached my job very differently, with the attitude of really doing what I could and trying to make impact, and less worried about growing up the corporate ladder. I think in some ways it helped me be a little bit more entrepreneurial and risk-taking, even though it was within the boundaries of a corporate life.
Yeah, indeed. And I think I always say that it isn't the end point of the entrepreneurial journey, but the journey itself that has so many more lessons. And I'm sure that flavors of that have creeped very deeply into DBS. So at a 20,000 strong bank, there is a very high entrepreneurial spirit. And a lot of people have been struggling with this digital bank story. You've been able to actually pull it off. One of the things I wanted to ask you was, what goes on in the thinking of the transformation? Because you're making money, it's a cash cow, you're doing really, really well. And to shift the status quo, risk that, and then to take a leap of faith and say, hey, that's where the puck is moving there, that's where I've got to be at some point in time. That just takes a lot. It takes fantastic execution rigor, but before that, it actually takes a lot of thinking process.
Frankly, sometimes you need a burning platform. You need something to give you a kick in the backside to start thinking. A couple of things happened in 2012, 2013. The first thing that happened is that we were trying to acquire a bank in Indonesia, and the government changed the regulations on us to prevent us from acquiring it. Already it was quite clear that most countries were quite protectionist about the banking sector, so you couldn't grow through inorganic growth and acquisition. And so it was quite clear to me you'd have to think of a new way to grow. One of our big challenges, we've done quite well in the 2009 to 13, I call that our first phase since I took the CEO job. We've done quite well, but what we've not been able to do was crack the distribution challenge in the big countries, the Chinas, Indias of the world. If inorganic and acquiring a bank was not going to be possible, then you'd have to think of a different way of solving the problem. So one issue. But the second thing that happened is I happened to have a meeting with Jack Ma around that time. And Jack painted his vision to me about what he wanted to do with Alibaba and Ant. And at the end of that 1 hour meeting, I walked out petrified, because I figured that what their vision was to move from an e-commerce enterprise to effectively be a bank without calling it a bank. They wanted to become a payment company. They wanted to raise money through a fund. They wanted to lend money to consumers. They wanted to lend money to corporates. They wanted to be an insurance company. And I came back, I remember telling my people, if it walks like a duck and it talks like a duck, then it's a bank. And so I started thinking, if Alibaba comes into banking and starts doing what they're doing in China over the next 3 years in my core markets, we're dead. So that sense of paranoia germinated from that conversation with Jack. But it also created a tremendous sense of excitement that there is a different way to do this. And so what I talk about, the two big insights I had at that time. Insight number one was this recognition that if we're going to win in the future world, we have to believe what Mark Andreessen says, that there are no more industries. Software is eating every industry. So you have to think of yourself as a technology company offering a set of bespoke services. In our case, a technology company offering a set of financial services. I started carrying a slide around which says, what would Jeff do? Except when I was in China, then the slide said, what would Jack do? But the point was, it was not what would Jamie Dimon do or what would HSBC do. The slide was to tell all my people, you got to start thinking, what would Amazon or Alibaba do, and how do you think like a tech company? My CIO, he spent 6 months going and visiting all the tech companies. And then he came back with an idea. It was a fantastic program. We went to Google, Amazon, Netflix, LinkedIn, Facebook, and so on. Everybody called them the FANGs. He put it together and said, you know what? These companies stand for GANALF, Ganolf, and it's missing a D. So he came up with this program of saying DBS should be the D in Gandalf, which is, as you know, the Lord of the Rings. So the packaging and the capturing the people's mind that we could be a tech company and think like a tech company, that was a huge insight. The second big insight was what you referred to, this thing of, the received wisdom at that time was legacy companies cannot change. And therefore, people said you should buy a startup, you should create a separate division, do this on the side because old people won't change. In fact, one of the people I met, Peter Ma, who runs Ping An Lupax, he told me the old people are like sheep. In this business, you need wolves, and you can't put wolves and sheep together because wolves will eat up the sheep. Now, I already told you, from looking at my father, I had this big belief that you can change adults. And so I came up with a second slide which said wolves can become sheep, or the way around, sheep can become wolves. And so those two insights we used to really energize the company, saying we can be a tech company. The advantage of, we created a program for change, a structured program for change, which had 3 dimensions. The first was, how do you redo the tech stack entirely? I realized that many of the old companies we talked about had started with old technology. Netflix had a very famous 3-day outage in 2007. And after that, they started migrating to AWS. They weren't born that way. So I said, we got to redo a complete tech stack and go into modern tech. The second thing was you got to really completely be customer obsessed. Dive into customer journey. And my insight to that was very simple. Uber became Uber not because they had better technology than taxi companies. Every taxi company has been using SAP for a long time. Uber became Uber because they reimagined the job to be done. Similarly, Airbnb. It's not like Ritz-Carlton didn't have technology, but Airbnb reimagined what the job was. So you have to deeply immerse yourself to understand what is the job to be done, and teach people the idea of journey thinking. And the third thing was really how do you create a sort of startup culture to be agile, to be a learning organization, to be nimble. So we created an orchestrated program of change in 2014. And sometimes hindsight is always easy. It's 2020. Look back and say a lot of things worked. Some of this we were lucky, some we didn't know. But by really hanging our whole shingle around the neck of customer experience, that turned out to be really, really useful for us.
No, indeed. So you now sound more like a tech company CEO, Piyush. If that's the space that you're going in, then what does the bank of the future mean? So what's the relevance, or what does a bank mean in the future?
So Puneet, first we've got to go back to what is a bank? And we ask the fundamental functions that a bank does are quite immutable. It helps people to save money. So you have extra money, you want to put money somewhere, so you save money. Whether it's in a bank saving investment, essentially surplus savings go into a bank. It helps people to move money around. So you need to pay somebody needs to pay you, so the bank does that. It helps people to borrow money because you need to put it to work in some way. So the way I think about it, a bank really does 2 things. You intermediate time and you intermediate risk. Intermediate time because some people have short-term savings, some people want long-term money, so you intermediate time. And you intermediate risk because you have extra money. The person who wants to borrow the money, you don't know. So you intermediate risk. Those functions of intermediating time and intermediating risk, those are quite fundamental and immutable. And if you think about it and say that is what a bank does, then I don't think those functions are going to disappear. The next question then you ask, who can perform those functions? Now, then you start opening up the Pandora's box, because what has happened in the last couple of 100 years, because you handle in a fiduciary way people's money, this is a regulated industry. You need to get a license, and only some people are allowed to perform those functions, particularly the savings function. Equally on the lending side, because banking could create a lot of financial system instability, there are a lot of rules and regulations built around that. I think that notion that you can find other ways to protect and safeguard both the savings pool as well as the financial stability thing, I think that will come to pass. You're already seeing that. And therefore, you find more and more non-bank competitors come in and perform those fundamental functions of intermediation that I talked about, including the payments function. So if you look at it increasingly, what does Ant do? And like I said, it's a bank. It raises money, it puts money to work, it uses its own balance sheet, it uses other people's balance sheet. It uses data to do that risk intermediation very, very differently, right? And this thing, and because it deals in micro numbers, large numbers of people, it doesn't take concentrated risk. What does Google do? Google's figured out through GPay in India how to move money seamlessly. Similarly, WhatsApp. So you'll find a lot of different competitors come in. I do believe that incumbent banks have a legitimate right to play in the space, because technology, anybody can get the technology. It's freely available. It's open source. So there's nothing which says that Amazon or Alibaba can use the technology and JP Morgan and DBS cannot. I mean, so the question of, can you be nimble? Can you be smart? Can you use the same technology architecture? But that's one chain. I think the bank of the future could be anybody. It is people who can do this role. The second thing, I think the bar on the customer experience has been raised extraordinarily high by the Googles of the world. When I started banking, it was okay for somebody to come and give me an application on Monday morning to take a demand draft, and I would tell them, you come back to me on Wednesday evening, I'll give it to you over the counter. And in my own journey, that 3-day turnaround turned to 24 hours. And the first day, I remember when you could offer same-day turnaround, you give me an application in the morning, I'll give you something in the evening, you were a hero. Well, can you imagine? I tell my people sometimes, if you type something into Google in the morning and you got a response in the evening, I think the bar and the customer expectation has been changed completely. So you've got to be able to learn. And to me, the key things you've got to learn is this. One, how do you acquire customers completely digitally or online? So Facebook, none of them have a sales force. None of them have a brand system. They have billions of customers. So you've got to learn from that. How do you do digital acquisition? Second, how do you do seamless transacting in real time? So you have the instant fulfillment and no paper. Third, perhaps more importantly, how do you use partnerships? Because all of these companies have learned how to deal through partnerships and ecosystems, platform plays. So how do you create partnerships and platform plays? Number four, perhaps most important, how do you master use of data? It's quite ironic that the banks were some of the earliest users of data in our credit card business, both for marketing and for risk management. In the last 20 years, we got left standing at the starting blocks by all the tech companies who refined the use of data to the nth degree. Now we've got to figure out, we have lots of data. We perhaps the best wealth of data. How do you use data in an intelligent way? How do you put AI on top of it? How do you create the right experiences for the customer, the right opportunities for the customer? So if you can do all this, then you can create a very different kind of bank. A bank where you can, I call it invisible banking. You can hide the banking function into what the customer really wants to do with their life. I can be part of your mortgage journey, your house buying journey. I can be part of your car buying journey. I can be embedded into your supply chain. I don't have to be visible in front of your face. I can be hidden in what you really want to do. I sometimes think of it as Intel Inside. So we can be Intel Inside powering what you really want to do in your life without actually being in your face the whole time. That's my vision of what a future bank might be.
Wonderful. So what advice would you have for young entrepreneurs who are now going out, and what gaps do you think, where do you think, particularly in context of the banking industry, areas that you would give advice to them that, pursue this particular niche? And maybe a cheeky question there, if you were an investor, as a personal investor, what kind of ideas would you invest into, Piyush?
So first of all, maybe a quick this thing outside banking. I just think that on the back of this epidemic, some areas, health tech, med tech, edu tech, ag tech, I think these are going to take off in a big way. We're already seeing that. And, everybody learned how to, study from home. Everybody is doing tele-advisory, everybody is doing tele-health consultation. And with small-scale agri-farming, some of the agri-tech things are going to take off as well. So I think there are large opportunities. I'm on the Singapore government task force for, how Singapore emerges from the pandemic. And we've been thinking about areas of opportunity. And several of these areas are things that we think that Singapore can play in. I think there's a general possibility around many of these. But more in the financial space, I think the whole agenda around AI and machine learning and thinking about how do you actually use data in ways which are conducive to compliance management, risk management, marketing, etc., banks have only scratched the surface. So anybody who can create a set of tools and productize a set of tools in the space could actually wind up doing quite well. As a general rule, I think the big opportunities in the financial system are really B2B opportunities. That's because B2C actually is not easy, because to go and build a new pool of customers, customer acquisition is very expensive. So most people who've tried to go directly into B2C in the financial services space have found it quite hard. But B2B is easier because you can plug into an existing pool of customers, whether it's a banking ecosystem or a taxi company or ride-hailing ecosystem or a telco system. But you can create a lot of product capability to power those B2B players, those ecosystems. So thinking about how to digitize, how to put AI, how to productize some solutions, but leverage some of the B2B capability and partnerships might be the way to go.
And Piyush, as a bank CEO, what kind of support do you think you can, provide to these entrepreneurs?
Well, financing is the obvious one, Puneet. And so again, in many of our countries, figure that, let me give you an example of Singapore to make it clear. So by and large, seed funding, angel funding, venture funding, there's enough of it available in Singapore. So we have a venture debt fund ourselves. It's small, it's a 100 million fund. But our general view there is we try to look for companies that are incremental and synergistic to our own business and what we're doing. But even in Singapore, there is a massive gap at Series B, Series C. So growth capital is a limitation. Both equity and certainly debt or hybrid forms of capital. I think that's a real opportunity for banks to be able to play a role and participate. Frankly, that's a time when many entrepreneurs don't want to dilute. So if you could actually get debt financing instead of equity financing, it would be good for you. And that's an opportunity for banks to be able to step up and do a lot more. So we're trying to see if we can create a growth capital platform to be able to provide support to entrepreneurs as they get to that stage. Finally, of course, what you said, we have a large ecosystem of our own. Both in the consumer space, the corporate space. And so for us to be able to take and work with a lot of startups to channel their products and distribute them plugged into our own products, that's something that's actually quite useful. And so much of what we do and take, some of it we make in-house, but a lot of it we work with partners to take and plug and play into our applications. So we're a fantastic distribution platform as well.
Thank you, Piyush. I know we're coming up close to the, at the end of our time. Thank you for your support. I really appreciate it. And as always, your conversation has been extremely insightful. And I wish that you would be the Gondolf, that you would continue to, apply the magic of your wizardry, and we'd get to see a much more reimagined, evolved, better customer experience and the value that you've provided. Thank you. It's been a pleasure talking to you. Really enjoyed it.
So Puneet's pleasure's all mine. So thanks for having me.
Thank you so much.